Okay, we're doing question 5 and the notes. Okay. So when we read, they say the following balance were extracted from the accounting records of light bulb. So are we all in tutorial 102, question 5, right? Page 21. Okay, the following were extracted from the accounting records of Light Bulb Ltd for the financial year ended 29 February 2012. The total sales, including VAT, which additional information number 1, there were 4,516. Administrative expenses, 1103. Bank charges, salaries, advertising, auditors remuneration fees, expenses, distribution cost, operating expenses, other operating income, the proceeds, equipment, not carrying amount, 24,000. Motor vehicle cost, accumulated depreciation motor vehicle, investments, loan to Life Smart, long-term loan, income statement, income tax. Light Bulb maintain a gross profit of 40%. So it means from whatever sales that we have, we must have a gross profit of 40%. Included under salaries and wages are the following payments to top management: salaries, traveling allowance, entertainment allowance, pension payments. Top management were paid $625 each per meeting for attending directors' meeting. 4 meetings were held during the year for both Light Bulb and Smart. The financial director is also the chairman of Live Limited and received a remuneration of 15,000 for the financial year ended 29 February. During the year ended 29 February 2012, Light Bulb Limited entered into a contract to make use of the machinery. The contract meets the requirements of a lease in terms of IFRS 16 leases, and the asset is classified as a low-value asset. Light Bulb makes use of the recognition exemption in terms of IFRS 16 leases for all short-term leases and low-value assets. The following information in respect of the lease agreement is available. The period of the lease is 4 years. Payments terms, installment payable monthly in arrears. Month 1 to 24 is 6.5. Month 25 to 48 is 0.5. The long-term loan was obtained from 1 January 2010, and the capital portion is repayable in 7 equal annual installments starting on 31 August 2010. Interest on the loan is calculated 10% per annum, is payable at the end of each financial year. Other operating income consists of the following: dividend received from Smart Live, interest received from Live Smart, and then investment consists of the following: the issued share capital of Live Smart is 80,000 in rand, share issued at 2 rand each. Light Bulb owned 21,000 ordinary shares in Live Smart, so we can tell our 80,000 divided by 2 will be 40, and then the total shares issued is 21. So 21 divided by 40 tells us that Live Smart is a parent of a Light Bulb. Then the Light Bulb owned 50,000 shares, where the 1,200 ordinary shares issued share in Stay Smart Limited. The share were purchased as for 100,000, and the share for the Stay Smart are traded on the JSE, and the market value per share was 3,000. So these shares were acquired solely for the sale. Then the share were valued at 3 rand each on 28 February 2011, and the market value on 29 February 2012 was 4 rand. So they increased in value, and no adjustment have been made up to so far. The non-current assets were depreciated on the following: motor vehicle 20% using diminishing equipment 20% straight. One of the motor vehicles with a carry amount of 40,000 on 28 February 2011 was sold on 31 August 2011, and only the proceeds have been recorded. All the equipment was purchased on 1 March 2009, and no sales or purchases of equipment were occurred since then required. Okay. So we're gonna start with sales, which is 4.5. Okay, so it's the statement of profit and loss. Who is the name of Light Bulb? The financial year is ending 29 February. Okay, we've got sales. Is the revenue. So our revenue, they said there was a statement on number 1. They will say it's 40% turnover and the revenues include VAT. So we have to take VAT out. So we'll say the total revenue we have is 4,560,123. We times by 100, then we divided by 114 because this side the VAT was 14%, but I think on the question that you will get, it will say VAT is 15%. So let's see, 4560 times 100 divided by 114 is 4 million. So the revenue will be 4 million. Then so we were told that cost of sale is not given yet, but we were told that the gross profit must be maintained at 40%, which it will be the 4 million multiplied by the 40%. So it's 1.6. So it means our difference here, it will be the balancing figure of this minus this. We all happy, right? Then you still remember the presentation that I told you that when you do your income statement, you must follow the abbreviation. Do you still remember it? I need your answer now. You are preparing to exam.
Yes.
What is the abbreviation? Going down.
It's G. It's GODAO.
GODAO. Whereby this will be gross profit, right?
Yes.
Gross profit. And then followed by the other income.
Then distribution.
Distribution. Cost. Then followed by
administrative. And then the other expenses.
Then other. Then we know, and after this, then will come the finance cost. Sharp. Okay, so we've got the G. So let's see the O. Which adjustment can be classified as other income?
Okay.
Adjustment which can be classified as other income.
The one with 19,000.
The one with 19,000 from
adjustment number 5.
Adjustment number 5. Let's see adjustment number 5. Other operating consists of dividend received from Smart 10, and then 6 and 3. Yes, I agree. Adjustment number 5 can be classified as other income. The next to be classified as other income.
We can also include the proceed on sale of motor vehicle, but we need to first establish what should go to the statement of profit and loss after calculating the
depreciation.
Residual, yes.
Yeah,
the
yes.
value.
I agree with you. And then the last one.
I think it says the one withheld for trading.
The adjustment number 6.2. You're referring to that one.
Yes.
Okay, let's see. 50,000. The share were valued at 3 rand. Now they're valued at, yes, I agree with you. So that one, it will be like this. So we'll say the shares held for trading. Shares held for trading. So when they acquire the shares, it was 50,000 number of shares. We multiply by, they acquired for how much? On 28 February 2011.
On February 2011, there were 3 rand. And
Okay.
on 2012, there were 4 rand. That means the difference is 1 rand.
Yes. So at the end of the year now, they will say 50,000. Then multiply by 4 rand, which now equal 200. So the difference will be 50. We are all happy, right? So the 50,000 can be added here. Then now we have to do the one for the vehicle which was sold. The vehicle which was sold, it was on which adjustment? Adjustment number 7, right?
Yes, that's correct.
Proceed on sale of the vehicle. The vehicle cost was how much? Did they give us the cost, or it was only the carrying amount? The
We
carrying
only have
amount.
Only the carrying amount.
Okay, the carrying amount is 40. Let me move this thing a little bit.
Sir, the 120 up there for the vehicle, motor vehicle at cost 120.
Which one? Up there referring to where?
On the balances were extracted.
Okay, the
Is
motor
the-
vehicle. Okay, yeah, the motor vehicle at cost is 120, but that one includes the all the vehicles.
Okay.
Yeah, because they don't say, if they were saying, if they were saying all vehicle with carrying amount of this were sold, then we were gonna use that cost. You get it?
Yes, sir.
Because they say one motor vehicle, but they say vehicle at cost, motor vehicles. You can see that they didn't say motor vehicle. They say motor vehicles at cost is 120. So it means there are many vehicles involved there, but we only sold one. So now we have to work with this one. So we can find the cost depending how is the depreciation method. On our side, they tell us the depreciation method is diminishing balance. So there is no need for us to calculate the cost. Is it fine? Unlike if they were saying they are depreciating at a 20% straight line, then we will have to calculate cost using our reversal method. So in this case, we're gonna just carry amount is given as 40, which this was given on cut. Let me put here. It was given on which date? 28/02/2011. So it means the vehicle was sold on motor vehicle with the carry amount of this on the February was sold on 31
Was sold on
August.
31 August.
August. So it means we have to calculate March, April, May, June, July, and August, right? So we're gonna do depreciation. Depreciation from 1 March we are
Yes,
happy again.
yes,
So, and they say depreciation is at diminishing balance. So we can happily use the 40,000. We all agree, right?
yes.
So 40,000 multiplied by 20%, multiplied by how many
6 over
months?
12. 6 over 12.
6.
Please calculate it for me.
It's 4,000.
4,000.
Yes.
Okay. So now 40 minus 4, we are left with 36, right?
Yes.
This will be the carrying amount on the date of sale, right?
Yes, that's correct.
So how much was the proceeds of this
The
vehicle?
the proceed was 42,500.
From the income from the trial balance, right?
Yes.
Please also notify people where you get it so that remember we are trying to assist each other here as part of preparing for exam.
Okay.
So the proceed. So if you are giving me an amount, also tell me where you got the amount. Like because someone maybe is clueless, doesn't know what proceeds you are talking about. So, but if you can say the proceeds of 42,500 from the trial balance, so that the person can go and check, or the proceeds of whatever amount from adjustment number 7, you see, at least we guide each other.
Okay.
So the proceed, which it will be the 42,500 as we get it from the trial balance. Then we're gonna less the carrying amount we calculated. The carrying amount we calculated
Then
is
we
how
get
much?
6.5.
Which is 36,000, right? So we
Yes,
left it.
36. And then we left with 6.5.
So our 6.5 is gonna represent the profit, right? Because
Yes.
we sold this, but it was valuing 36. So we made a profit. So the profit will be recorded as income. Then we can happily say this amount of 6.5 will be regarded as our other income. We're happy. Then let's add all the other income. There's 19 plus 50 plus 6.5, 75,500. Fine. Anyone who have question up to so far? Any question? Okay, I assume everything's fine. Then let's proceed. Then administrative expenses. Remember, we are following our structure. So we have a gross profit, sharp. Other income, sharp. Do we have any distribution cost? I didn't see anything. Let's see. The distribution cost. We do have.
Yes, we do have.
Okay. Let's put distribution cost.
Yes.
Our distribution cost is regarded as how much?
It's 134.
The 134, which was given from the trial balance.
Yes.
I agree. Then, do we have admin? Yes, we do. Our administrative expense was happily calculated on the trial balance. It's given as 1103. And then what next? This one done.
I say
Yeah, ball.
adjustment number 2. Are we not gonna work? Are we not
Adjust-
working out the adjustment number 2 to revise the salaries and wages?
Adjustment number 2 to revise the salaries and wages. Why are we revising them?
Network.
Sorry?
Okay, sorry, it was my network. I'm on my way to Limpopo. Adjustment number 2 for salaries and wages. Are we not
Yeah.
gonna consider it on the administrative expenses?
It was already included there.
Okay.
Remember, check your administrative expenses on the trial balance. They say salaries and wages. They put information, additional information number 2. So it's already taken into account.
Okay.
Yeah.
Okay, thank you.
All right. Thank you. Then let's proceed. Then we can go to the other expenses. Other operating. So our other operating expenses, we are given as how much? 217,500, whereby there is information on the finance cost. The finance cost is included, so you have to take it out. Can you see that information?
Yes.
So that finance cost, you have to take it out. That's the first step. And then what else is included, which must be taken out? Let's see. The operating lease. No. When you do your equalization here, you will see something that need to be taken out, either accrued or so. Let's work the finance cost. Then after we work at the leases, then from there we'll see which amount needs to be taken out. So finance cost. Because they must be excluded there. So finance cost, where is the information relating to the finance cost? The loans. Loan to Life Smart P2 Limited 40,000, long-term loan credit 45,000. So let's see the loans. The long-term loan was obtained on 1 January 2010, and the capital portion is repayable in 7 equal annual installments starting on 31 August 2010. Interest on the loan is calculated 10% per annum and is payable at the end of each financial year. Loan acquired is how much? 45, ne? From the pre-adjustment trial balance long-term loan, yeah, it's 45. So they say it's payable in what?
In 7 equal annual
In
installments.
So the 45 divided by 7, so how much?
5,000.
Eh?
5,000.
Why are you giving 5,000?
45 divided by 7, it's 6,428
Yeah.
57 cents
Okay.
if you round off.
Okay,
Right.
so the one who was giving me the 5,000, where did he get the 5,000?
No, sorry. I had a different number in my head. Sorry.
Oh, okay. So it's 6,428.57. Let's say 6,429. What did they say about the rounding off? Also, answer must comply with IFRS. They don't mention anything.
9.
They didn't mention anything about rounding off.
Yeah, they didn't mention it. It's fine. Okay. So this in thingy, this loan is payable in 7 equal installments, and then starting on 31 August 2010. So the loan was acquired on which date? 1 January 2010. So 1 Jan 2010, the loan was 45,000. And the payable is on 6 months. It's payable in 7 equal annual installments starting on 31 August 2010. Interest on the loan is calculated at 10% per annum and is payable at the end of each financial year. The interest is payable at the end of financial year, but the payments are made on 31 August. Please note the two. So here we have a
Sorry,
payment.
sir. Can you please repeat that? Sorry, sir. Can you
Mhm.
please repeat?
Yes, I have to repeat. Let's read adjustment number 4 all together. The long-term loan was acquired on 1 January 2010. Here is our 1 January 2010, 45,000 sharp. The capital portion is repayable in 7 equal annual installments. Here is our 7 equal annual installment sharp. These 7 equal annual installments, they will be payable from 31 August 2010. So it means starting on 31 August 2010, we'll pay 6,429. The interest on the loan is calculated at 10% per annum and is payable at the end of each year. So the interest will be payable at the end of financial year. However, the amount that we are paying will be paid on every 31 August. So every 31 August, we pay the payment, but the interest will be done at the end of financial year, meaning at 28 February. So we are having two situations here, the payment versus the interest. We are all happy.
Yes.
Okay.
Yes.
Now, from 1 January 2010, what comes first after this date?
It's a payment.
The payment. So we have a payment. So the payment, it cannot be the payment because they say the payment will start on 31 August. Read that information. In 7 equal annual installment starting on 31 August. They didn't say starting on on February, because remember here the financial year need to end. Our financial year is ending on February. That's why I was asking from here what comes first. It's not payment.
The interest for the 2
So we have to do the interest for the 2 months in 2010. So we'll do the interest, which it will be the 45,000 multiplied by what?
Multiply by 10%, multiply by 8/12.
The 8/12, where do you get it?
I think it's
Okay, the 8/12, I got it from, as they say, the loan was obtained on the 1st of January. So I counted from the 1st of January to the 31st of August, as there will be the first payment. So I have to do the interest on the initial payment before they made the first payment installment.
Okay, so you move it straight away. You didn't even do the financial year. You just move it straight away and go to 31 August, which is still fine. So I'm not arguing about it. It's like the other shortcut of it. So in my process here, I was gonna do the 2 months first and then do another 6 months after. Then I combine the two, then it be 8 months. So let's do this. Not arguing with you. 2 divided by 12. Then we close. Then from there, we have another interest. That will be. So did they mention this thing that capitalized? They don't say anything. So it means it's not capitalized. So if it's not capitalized, we're gonna use the 45,000.
Sir,
Yes, I'm listening.
okay, I understand the part, yeah, the interest times 10% times 2 divided by 12. I understand that because of this January, February, since they're saying we're paying the interest at the end of each of the financial year. But right now, when you're talking about the 6 months, I actually don't understand it, because I thought maybe after calculating for January and February, then we're going to calculate for the whole month next year. And then the interest that we're going to calculate is going to be for the end of 2011.
No. Yeah, I get you, but before you really can continue, the answer is no.
Okay.
Yeah, then you see why we are doing this. So here, let me do this. The interest, yeah, 2 months, 45,000 times 2 over 12 times the percentage,
750.
More 700, more 750. So I don't know which one is correct.
750.
Oh, 750 sharp. Then let's I want to do this using the capitalization, because from my understanding, there must be capitalization, even though they don't mention it. We will correct where deemed necessary. So 4,000, 45,000 plus 750 over 750. Then interest, yeah, from 1 March 2010 to 31/08 2010, when the payment starts. Ne?
Yes.
Okay. So let's say 45750. I want to check something. Multiply by 10%. Multiply by 6 months, which is
2,250.
So I want to do this separately. Then I want to do it via interest capitalization versus when the interest is not capitalization, because I want to see where will be the difference. So the one with capitalization, you said the interest is how much? 45,750 times 10% times 6 over 12. You said it's how much?
It's 2,250.
2,250 sharp. Without capitalization, it will be 45,000, and then here is 750, but we don't capitalize it, and then we remain with 45,000, and then we say 45,000 times 10% times 6 over 12 times 6 divided by 12 and times 0.10 is 2,250. 45750 times 0.10 times 6 divided by 12. Here
No,
it can be,
yeah.
Here can be, here
It
should be, it should be
87.
Sorry, sir.
228.
228.
or 2289, depending. Because this one is the one of 2250. Sharp. Okay, then let's proceed. Now there is a payment. Okay, someone is asking.
No, I was saying when we round off that 25750, it gives us 2288, not 89.
2288.
Yes.
So like this.
Yes, sir.
Okay. So let's the payment. The payment is how much? 64.
28.557.
Eh?
No, it's fine. You rounded off. I was not rounding off until the last.
So suppose we don't capitalize, it will be this minus this. Like it will be our, we'll say, equal this minus this. Or it's gonna add. Okay. This plus, then here it will be this plus this plus this. Okay, that was up to 3108-2010, and then we go further from the further 6 months off from August to February 2011. Then 28/02/2011, when they're closing the financial year. So they made a payment, then they left with this, then they have to do the interest for another 6 months. So we'll say the 41,609 multiplied by 10% multiplied by 6/12. We're still in the same page.
Yes, we are.
Yes.
It will be 2080.
2080. So the other one on that side, it will be, we less the payment. So we'll say 38,571 times 0.10 times 6 divided by 12 is 1929. Okay, I want to read something here first. Okay, this thing is wrong. I pick up something. The long-term loan on 28 February is given as 45,000. We are all happy, ne?
Yes.
And this thing, it was acquired on 1 January 2010. So please wrap everything together. This thing, just wrap it all. We will say delete all this thing together. So here we've got to have loan acquired. We don't know it. It will be exclamation mark. It will be question mark. We don't know the loan acquired yet. The only amount we have is here. We have 45,000 here, which the 45,000 here was given on which date?
29 February 2012. 29 February.
Sharp. So the loan was acquired at this X amount that we don't know, but it was acquired on which date?
On the 1st
1
January 2010.
sharp. So from the date of acquisition, there were interest and interest, blah, blah, blah. So how many payments were made up to so far?
There are two from
Two payments.
2010, 2011. Now it's
So the-
2012.
So they made a payment on 31 August 2010. And they also made a payment on 31 08 2011. Ne? Happy, ne?
Yes.
So
Yes.
payment number 1, payment number 2. How many payments left?
Yeah, 5.
5, ne? So we're gonna say payment per year, it will be calculated as follows. $45 divided by 5 is how much?
9,000.
So it means this person was paying 9,000 every year. Now they paid 9,000 here. And they also paid 9,000 here. So let's reverse everything together. 45,000 plus 9,000 plus 9,000, it will be how much?
63,000.
Sir, why did you divide it by 5 instead of 7? Because of they said 7 installments.
Yeah, you are right. I don't know if you were listening when I was doing these figures. Remember here we're having XX, we're having question mark here. It's the amount of loan that we don't know how much they acquired, right? We were given this figure, the green one.
Yes.
This is balance of the loan, ne? On that date.
Oh, okay.
Right? So
Yeah.
this the balance of the loan on this date is 45,000 given. My question then was like, okay, the loan was acquired on this date, 1 January 2010, for whatever amount that we don't know. There was a payment made on 31 August 2010, right? There was another payment made on 31 August 2011. So my question about now, how many payments were made before this date? There were 1 and 2. There were 2 payments made. So if there were 2 payments made, how many payments left?
5. Okay.
5.
Okay.
So on this date, we are left with 5 payments. Because 2 they already passed.
Okay.
So
I get it.
the payments left, which is 5, then we say 45,000 divided by the payments left, which is 9,000. So 45,000 divided by payments left of 5, then we have 9,000. Then now we are reversing. We say, okay, we have a balance of 45,000. We paid 9,000 last year. We paid another 9,000 that other year. So it means the loan we acquired at the beginning is how much? That's why it was 45,000 plus 9,000 of last year plus 9,000 of the other year.
Okay.
So we are happy that now we are arriving at that amount of 63,000. So at the end, we're still going to have 7 payments. It will be these 2 payments plus additional 5.
Okay.
Sharp. Now, let's calculate our financial year. Is ending on which date?
And February. February.
It's ending on February, ne?
Yes.
No, let me put this thing here. It's ending on February of 2012, ne?
Yes.
So here we have a 45,000 as given. Now we want to account interest. So there will be interest from 31 August 2011 to 29 February 2012. And then there will be interest there. There will be interest there between this side before the payment. The interest that we're gonna start on 1 March, ne? 1 March to August.
31 August for 6 months.
Yes, so it will be 6 months this side and 6 months at that other side. We all happy. So the 6 months for this side, it will be how much? How are we gonna calculate that 6 months? We have 6 over 12 multiplied by 10%. So what amount do we multiply these figures?
It's 54,000.
Do you agree with her?
Yeah, because you take the 45 plus the installment of 9,000.
So that we can get the balance before the payment at 51
Balance
August.
before payment.
Yeah.
Yes.
Okay.
How
And
to
then
get 54,000?
I know that there will be issues here. The 54,000 came as a result of the balance we have, the green one, on 29 February. Is the balance we have now, today, when we are closing the books. But we wanted to know how much was this loan last year on 29 February 2011.
Yes.
So in order to go back, we will say 45,000 plus the 9,000.
All right.
We happy?
Yes, I'm happy now.
Okay. I want to check something here. Loan payment, first payment, it was done in 2010 of 9,000, then 63 minus 9, we remain with 54. Then 54, we have to less 9 again. Then here should be 45.
45,000.
So this one should be 45,000. But the 45,000 comes as a result of, it was 54, then we less the payment made on 31 August. So from 31 August to the end of the year is 6 months at 45,000. Do we get it? Let me add line here.
So 45,000, you say we're gonna use it at what? At what period of interest from?
You're gonna
use it
you're gonna use it from
August to
yes
to February.
Yes, it's the one we're gonna use it here. Here's where we use it. Again, this thing was 63 at the beginning. You minus 9,000 or shall I 54. So the 54 here we told them more is the 54 balance on 31/08/2010. Then from there, you do whatever you do, you're gonna have another payment later. Let me add another line here. That wrap these things. Yeah. So let's work this thing again. We have a balance of 63,000. That's when we agree how we calculated it or how we arrived it. We have a payment on 31 August, so it's 9,000. So the 9,000 it's one, then the balance remaining on that date is 54. We all happy, né? So we have to calculate the interest here on the 54. Then from there, we do another payment of 9,000. Then we calculate the interest here. And then we have the same balance of 45,000 at the end of the year. It makes sense.
Yeah.
So our interest for another part, it will be here at 54,000. So our interest calculated here is how much? 45,000 times 6 over 12 times 10%.
It's 2,250.
2,000.
250.
Okay. So the one at 54,000, it will be how much?
It will be 2,700.
2,700.
So it's 2,700.
Yes.
Okay. So is there anyone who doesn't
Yes.
understand? Is there anyone who doesn't understand the blue shaded figures? How to arrive at them?
So I just have one question. Considering that the 45 was given in February 2012, are we then to assume that they did not take in consideration the last interest that should have been calculated?
Which last interest?
Okay, so were you adding the 9,000 to get to the 54?
Where I add 9,000 in order to get 54.
Yes. Are we to assume that the second part of the interest for the year was never calculated before they closed to give us that 45,000 balance?
I'm trying to follow you, but I don't understand. I don't know you are referring to this portion. You are referring to this portion, or you are referring to this portion. Which one are you referring to? The top or the bottom?
The top part. So, okay, so if we look at the balance, they're given at February 2012, right?
Yes, yes.
Just hold.
That's today. Let's assume this is today.
Yes.
Okay.
And we are preparing the statement for February 2012.
Yes.
So it's within the same year.
So it means the financial year will start on 1/03/2011 up to 29/02/2012. Okay. So this will be our financial year.
Okay.
Okay.
Yeah.
So the balance we have after payment, remember we are having the 31/08/2010. Okay.
Yes.
We paid 9,000. We are left with 31/08/2010. So this balance at 54,000 on 31/08/2010, it will still be the same balance on the 1st March.
Okay.
I can remember they're gonna do a payment ka August.
Mm-hmm.
So repatala today ka 31 August 2010. Ne? Robara patala gape next year ka 31 August 2011. Mara between, let me do a timeline. Today, Gili 31/08/2010. Ne?
Yes.
I'm doing a payment here. Because I know most people, they understand this via timeline. So
Thank you.
from here, it's just I can't draw, Mara. At least my demonstration will show that I'm doing a timeline. From here, the next date will be what? The starting of financial year.
Yes.
That will be financial year start. Fin year start. Which it will be 01/03/2011.
Yes.
Then we proceed. Then there's another payment here, somewhere here. Payment. which it will be on 31/08/2011. Akir.
Yes.
Then we close. We go back. Then here's our closing day. Financial year end. Fin year end. Ne?
Yes.
So I will use this financial year. I'm sorry. Let me rub this one. Our financial year is here. So when we start our financial year, that date 1 March 2011, loan yarona in a yemi kovakai.
It will be,
It should stand on 54.
yeah.
Because remember, it's 54,000. Here is the payment, 9,000. And then when it go back, further back, it will be on 63,000.
Yes.
Okay. So now our financial, we made a payment card is 31 August. So there's no 63 and 9,000 31 August 2010. We are left with 54 on that date here. We are left with 54 here. So the same 54 that we are left with, it will still be the same balance when the financial year starts.
Okay.
Push up.
Yes.
And then the financial year starts. So it means from here to here is 6 months, Akir.
Yes.
So the 6 months will be using the 54,000. So it means here it will be 54,000 multiplied by 6/12, then multiplied by 10%. Push up. Akir.
Yeah. Yes.
So which it give you the amount, okay? Yeah, 2,700. Akir.
Yes.
Then we do a payment here. Then when we do a payment on this day, the balance is no longer 54. Yeah, decrease. Further 9,000. Akir.
Yes.
So after that further 9,000, research 45. So it means the balance remaining now will be 45. Akir.
Yes.
So that 45,000, it will continue until year end. So it means our interest, the next interest will be 45,000 times 6/12, then times 10%.
Okay.
Is sharp.
Yes, I'm fine.
I think with the method of timeline is much better as we got the horizontal part.
Yes. Okay.
Anyone who didn't understand? I think none. So this I will just paste them somewhere here, so they will go further down. Then I delete
Sir,
this. Mhm.
can I ask a question? It's not
Yes.
about this income statement, but it's about the same transaction like this. If we were about to do statement of possession, and then these parts of current assets of the portion, we were gonna use 5 or we were gonna use 7.
Okay, if we were doing the statement of financial position,
Yes.
so
The
remember,
current
please. Remember on the statement of financial position, we don't take anything in. We don't take the payment into account. So we're gonna only use the 45
Oh, as it is. We
as
will
the
not
balance.
gonna.
Yes, because it will be the balance at the end.
Oh, okay.
Yeah.
Okay. Get it.
Okay. So can we conclude that we did have the finance cost of this? So the total finance cost, it will be this plus this for the whole year. I can.
Yes.
So those are the ones which they need to be excluded from our operating expense. So from our operating expense, we will say we have an amount of given figure. It was how much? 217. Then we less the total really total.
It's 4,950.
Okay. Then let's do the one for the leases. Then we do the leases. Let's see what the leases have. On the lease, we have 1 October period, 1, 10, 20, 1, 1, 2, 30, 09, 2015. So the first 24 months, how much was paid? 1 to 24. They were paying 6.5,
6.5.
right?
Yes.
So it will be times 12.
It's gonna be 78,000 times 12.
Another. Aye. Then from 25 to 48, they're paying 6 or 3,500 multiplied by 12. So much?
It's 42,000.
Then we add all this together. 120. So we say 120 divided by 48 months. I get it.
Yeah.
So per month,
It
they must pay this.
2.5.
No, sir, I'm a bit lost. I mean, you use the 12 months, but you multiply the total by. You divide the total by 48,000. Whereas you use the amount of 12 months.
It's 48 months, not 48,000.
Because to me,
no, I think she referred
how
to here.
I did it.
She referred to here. I know.
I refer.
She referred to here.
Yes. And the totals also are wrong because they are for 12 months, not 24.
Yeah. So should be 6.5 times 24.
That is 156,000.
And then here.
I got 84,000.
And then here.
I got 240,000.
Yeah.
And then per month I got 5,000. 5,000 per month.
Yeah. Sharp. Then.
Sir, if I may ask, what guide us to what months to times with? Since they say it's per month, it's 4.5. So the guideline is from the first payment that says 1 to 24.
Yeah.
Okay, now I get it.
So 1 to 24, we should 6,500 times 24. 25 to 48, we should 3.5 times 24. That's the guideline.
Okay, I get it, because me too, I was using 12 when I was calculating this thing. But now, as you say, I see.
Okay. Then we say it's 5,000 per month, right?
Yes.
So the lease started on 1 October 2011. And financial year is when?
29 February 2012. From first.
Bible. 29 9/02 2012. So the lease started October. So October, November, December, January, and February, right?
Yes.
Which is 5 months. So what actually paid?
The actual paid, it was 6,500 by 5, which is 32,500.
What was supposed to be paid?
It was 5,000 by 5, which is 25,000.
Is 5,000 times
by 5,
which is
25,000.
25,000,
yes.
Okay. So what is the difference?
There's a prepaid of 7,500.
So this is a prepayment, right? We happy. So let's go back to our question on the other operating expenses. So on the other operating expenses, we paid this, né? But we were supposed to be paying this. So it means we paid 7,500 more, which it must be deducted from that amount we paid so that it can go to the financial position. Is it clear?
Yes.
Okay.
Yeah.
So it means when we go back here, we will say on our thing, we also less the 7,500. That comes as a result of the prepayment that we did. Anyone who have a question? That was the main reason we were doing those calculations. We're trying to figure out what is included here, which was not supposed to be. Remember the finance cost, they told us straight that, okay, on this other expenses, finance cost is included. They just told us that one straightforward. So we have to exclude it. Depreciation, after all, it have to be included. So they were just confusing when they say including depreciation. They know that you, for the fact that they say including depreciation, you say, then it must not be taken into. Then you less it, then you get it wrong. So here it will be the 217,500 less 4,950, which you know how we calculated it, then less 7,500. So it means our actual operating expenses is 205. Anyone who have a question? Any question? So what next? We are finished with our abbreviation.
Finance.
What is next is finance cost.
Finance cost. Our finance cost, how much is already calculated, Akir. So for those which they wanna still see it, it will be our 2,250 plus the 2,700 as calculated more. The calculation that we're doing here. Then what next?
And then it's
Profit.
profits before tax.
The profit before tax. Then this one will be calculated by equal this plus this plus this. Then it give me the 228,500. Then we have income tax expense. Is it given or it need to be calculated?
It's given.
It's given from where? Adjustment or from the free? Okay, 64,000.
On the trial balance is 64,000.
From trial balance. Then we're gonna have a profit. The year.
After tax. Oh, for the year. Tax after tax.
They say it must comply with IFRS. So if you say profit after tax, then they might give you wrong there. It's not comply with IFRS. You asked the one of profit after tax. Then we have other operating. And other comprehensive income. Did we have any revaluation done during the year? I didn't see it.
No.
I also see it.
Yeah, I can say we are done.
Mr. Mulapo, can I ask you on a question on other comprehensive income, please?
Yeah. Yeah.
On other comprehensive income, is it when we had a revaluation and also when we have shares that were not held for trading?
Yeah, so here things to be included here, it will be your revaluation plus share held not for trading. And those shares not held for trading, you only take the differences, like whatever it was valued last year versus what is valued now. But when you take it into the financial position, you will be taking their market value at the end of the year. And the market value at the end of the year for shares held not for trading, it will be the financial assets under non-current assets. The shares held for trading, it will be the financial assets under current assets. Anyone question?
So, let's say maybe we were given income tax expense, but there's also maybe a transaction. So, how do we calculate it if we were not given? Like, do you have any structure of how to calculate it?
Okay, yeah. You say, let's say we are doing a statement of profit and loss, and then income tax is
Income tax, maybe we were given it, but it also have its sort of transaction with maybe it was payable or a current tax.
okay.
After...
So you're gonna use the 1 year income tax expense only. If they give an income tax expense and then they come back, they say the income tax payable at the end of wara is this much. That one you're gonna use it for financial position. It's where you're gonna check the one which is expense versus the one which is payable, so that you can able to know whether it's a liability or is an asset. But normally that one mostly is for FAC third year. It's very rare, but one more second level. But I know what you're talking about. But in your case, if they give you that income tax payable on 31 or 28 February 2012, it was 45,000, and the bar where I have about income tax expense for the year is 9,000. You use income tax expense, not payable.
Okay.
The payable will affect your balance sheet because it will be the liability.
Okay.
Yeah. Any question before that? The thing it was they say do note number 2. The director's remuneration. And so the note number 2, it came as a result of your, when they say do, what do we call? They say they want the profit before tax note. So you have to show those things, which your honor doesn't take long. You just like, it's marks just given free of charge. Yeah, regard as the free marks, the profit before tax, because it's the same thing that you did in the income statement. You just repeat it. So let's see, profit before tax, note. Then you say profit before tax is disclosed after taking the following disclosable items into account or into consideration, depend on you. By writing this thing, that statement, say nothing. You just get yourself a 2 marks for this. If you say profit before tax, but you don't write this, you lose your 2 marks. Like I say, this is just a free thing. So suppose you write the exam, then they ask you profit before tax, you must be happy that they are just giving you 3 marks. So let's start. Income. What did we do which it form part of the income from what we did from our thing? We're gonna check things that they are income here. The first one, which is an income.
It's a revenue.
Revenue. Of how much?
Of 4 million.
What next? What is
It's
another thing?
income.
Which income? We are already in income. We are dealing with income. Which one?
Well, okay, we will start with AMA shares.
AMA shares.
Yes, the 51.
The 51. Okay. So those shares, we're gonna call them fair value adjustment. Because the market value was changing from 4 rand to 5 rand, ne?
Yes.
So you can say 5 rand less 4 rand, then multiply by how much shares acquired? 50,000, ne? So
Yes, it was 50,000.
Another one.
It's a profit on non-current assets.
The one we were selling vehicle. The
Yes.
one we were selling.
The one
The one
which
we
is
were selling.
60. The one
From myself.
Yeah. 6.5, right? Then what else? Are we done with our income?
Yes, we're done.
No.
No, I refuse. We're
not done.
We don't. We counted this.
We're not done, sir.
We can't. Yes, that's why I refuse. The other one said we are done. Then I said no. We counted this. We counted this. What else does it mean?
We still got the tradition adjustment number 5 to write as an income. We will separate the one from Smith, Smart. Its dividends received. 6,000 or 3,000.
I get you. Yeah. So we have to separate this thing. Now we're gonna say the one from subsidiary. We have to check which one out for subsidiary.
Yes.
So the one from subsidiary will be from adjustment number 5. Let's read. We said we received the dividend from the following companies: Stay Smart, Live Smart. Then adjustment number 6.1 and 6.2 tells us that the issued share capital of Live Smart is 80,000 shares. I mean, it's 80,000 rand. The shares issued at 2 rand each. We as the light bulb, we are the light bulb, ne? We as the light bulb, we own 21,000. So just to do a small calculation here.
They issued 40,000 shares.
Share issued is 40,000. And we own how much?
21.
21.
So we control how much percentage there?
52%.
So it means this person is our subsidiary, ne? We happy. Subsidiary is when you owe 51% up. So it means that person is a subsidiary.
Wait, sir, how do you get that 52?
It's 21,000 divided by 40,000. 21,000 is the number of shares I own versus the 40,000 of the shares issued by that company.
Oh. Oh, okay, now I get it. Because I know which is the shares number was, I get it from 80 divided by 2 rand, and I got 40. Oh, okay, now I get it.
We happy, ne? That's why we can say Live Smart is our subsidiary. So now let's check, what do we receive from Live Smart? We received dividend, ne?
Yes, we received dividends of 6,000, and you also received the interest of 3,000.
Okay. What else is missing? Then we do the one for other people. So income from financials. So the income from other financials, we received what?
We received the dividends from Stay Smart of 10,000.
The dividend from Stay Smart. Is based on the shares that we acquired. I can remember we acquired 50,000 shares from him. You remember, ne? Adjustment number 6.2.
Yeah.
So they pay the dividend based on that one. Because the shares were traded on JSE, so we can call them listed investment. So we received what? Dividend of how much? 10,000. We are done with income, ne? Me, I can say yes. Because the 19,000,
yes,
it will be covered by this. This will cover the 19,000. Then the 6.5, the 50,000, the 4 million. We are done. Then we can go to expenses.
So on income from subsidiary, that's the only way we use to calculate, we'll see which one is a subsidiary and stuff. Because I mean, I was just robbing it. I was just looking at the names and say, okay, if this person pays us dividends and also pays us the interest, obviously he's the one with the...
It doesn't go like that. You have to calculate. You have to calculate to be sure. No, you were wrong. You have to calculate to be sure. This is how you calculate it.
Okay,
you check the share issued by that person versus the shares you acquired. These are the share issued by him. These are the share you acquired. Then the shares you acquired divided by the shares issued by him. Then if the amount is greater than 51%, then it means that person is a subsidiary. Like for example, check the 1 year smart, the 1 year Yanto, yes, Stay Smart. On Stay Smart, if we do the same method, the share issued by a smart guy.
Let me see. Share issued limited to
adjustment number 6.2.
It's 100,000. 100,000.
So it's 1.2 million.
The question, let's read. They say light bulb, which is us. We own 50% of the 1,200,000 shares issued. So Stay Smart issued 1.2.
Oh.
And then Reina, and then from there, Babari, the share were purchased for 100,000. So those are the shares purchased by we purchased 100,000. The shares that 50,000, we purchased them for 100,000. So that one is just information, G. Then the shares owned by us is how much?
50,000.
Then 50,000 divided by equal, okay?
24%.
24%. You say 24?
Yes.
Wait.
50,000 divided by 1.2 million.
It's 0.04111. Okay, it's
then
it's 4.17.
Yeah, it's 4.17%.
So 4.17%, you can tell the person is not even closer. So we are not even closer to be, the person is not being closer to be a subsidiary. So it's out. So that's how you calculate your subsidiary. Where Namotauri you receive things twice, then it means the person is a subsidiary.
Mr. Mulepo, don't we say the shares, the total shares divided by the shares that we occurred?
The total shares divided by what?
The shares that we occurred.
Then are you gonna get percentage?
Yeah.
How?
Like in that case, when I say 1.2, 1.2 divided by 50,000.
Then what does it give you?
24.
It's not the way you calculate percentage.
No, I get it. Yeah. It's fine.
Okay, any question? Thank you. Let's proceed. Things that they relate to expenses. What are the expenses?
We have
Those
the
people
salary
now
and
the amount they are freezing. How? Can they along guys? Are you not writing next week?
Of course.
Don't want the guy. On which date are you writing? I just know it's next week.
Friday.
14.
Friday, can I come?
Eight.
In the morning or at night? Phela
In
le ka ngwala in the night.
the
Unisaki.
morning.
Oh. With Unisabel, you can write in at night.
Oh,
Okay.
Tactic.
So expenses can only staff cost that you need to be taken into account. That's like remote, you just free max, guys. If they say you must do a note for project before tax, then if you fail, it's up to you. Staff cost, guy, how much is our staff cost? The one who was more with salaries and wages. Can you give me the figure?
It's 1 million.
And then the auditor's remuneration, how much does he pay these auditors?
I think it's 24.
You think?
Yes, when I calculate it from here, it's
Why don't have the
20.
exact answer?
Yeah, the expenses.
It's 24.
Okay. Answer as if you are the one writing exam. It's 24, ne?
I was also gonna write 24.
Okay, and then depreciation. This one you have to calculate it. You didn't calculate it at the top. You only calculate one portion of the depreciation. You didn't calculate the rest. So for now, let's put it the exclamation mark or XXX. And then the last thing, the leases. We calculated it. Short-term leases. We said we paid. Where's that thingy? Gosh. We paid.
We said we paid 3.5.
We paid 32.5, but we were supposed to pay 25. So this is the one that we're gonna disclose, the one which we were supposed to pay. So here we put 25,000. Short-term lease payments. So suppose you got the depreciation wrong, at least again on only 1, 2, 3, 4, 5, 6, 7, 8, 9 marks free, which it will be even more because some they marks them as 2, some is 1.5. Do you see those? This was just a free marks G. It's like repeating the same thing that we've done on number A, but in another format now. So let's calculate depreciation. Depreciation calculation. Depreciation on sold vehicle calculated. We can't repeat it again. Really, okay. Go back to your notes.
It's
Depreciation
4,000.
Okay, 4,000, ne?
Yes.
4,000. So the remaining vehicle now. Now is where it's gonna go to that thing your cost. Who was asking about the cost of 120,000? The motor vehicle on 29 February, they were valuing 120,000, and the accumulated depreciation on motor vehicle was 30,000. So this accumulated depreciation, it will be regarded as the balance given at the end of the year, or it's at the beginning. So then the minute they didn't mention, so we're gonna regard it as what? Given where? Okay, let's work it out then. We've got a carrying amount given, or we have to calculate it on our side. The vehicle was cost it was 120. And then the accumulated depreciation given. Accumulated depreciation given is 30, ne?
Yes, 30,000.
Then we say 120 minus 30, we are left with 90.
Yes.
So the minute they didn't, if you can check on the pre-adjustment trial balance, they said accumulated depreciation on equipment at carrying amount is this, and then accumulated depreciation, they didn't give you the for motor vehicles. I mean, for equipment, they didn't give you the thingy, the accumulated depreciation. And then now they come, they say motor vehicle at cost is 120, accumulated depreciation on motor vehicle is 30,000. So the 30,000 that was given, it will be the one at the beginning. Then we say, so here is the accumulated depreciation at the beginning. I mean, the carrying amount, sorry. It's carrying amount at the beginning or in the beginning of 90,000. This one, remember, because it's still at the beginning, is also including the vehicle sold. Ne?
Yes.
This will be on the 103 20 11. Ne? So it's including the vehicle sold. So the vehicle sold, it must be taken out. The accumulated depreciation of the vehicle sold, it was how much on that date?
420.
Nilo, okay? Actually, initially the vehicle carry amount was 40,000. Where did we calculate it? Should be at the top. It was 40,000, the carrying amount.
The accumulated depreciation of the sold was 36.
That one is at the end. Again, now it will be 36 at the end. Again, it will be this.
Yes.
So this will be the carry amount at the end of the vehicle sold. So now we have to take it out here. We have to say on that 90,000, we minus 36. So it will be less vehicle sold. It's carrying amount. The vehicle sold carrying amount when we were selling it.
40,000.
The carrying amount of the vehicle sold when we were selling when we were selling it.
It was 40,000.
It was 40,000 at the beginning. Then we took out the depreciation. So now carrying amount on the date of sale. I want this figure. This is the figure I'm looking for, this one. So it's 36, ne? Remember, now we are dealing with the carry
Yes,
amount.
it is 36.
So we'll say this minus this.
Square to 54.
We are remaining with 54, ne?
Mm.
Sharp. So here is less, ne? Now we were told, or this thing they are depreciating at 20%. So here, this is the carrying amount given on which date? The 54,000. This will represent the carry amount at the end of the year.
Yes, it represent the end of the year.
We all agree that this will be the carry amount at the end of the year.
Yes.
So now we have to go back to the carry amount at the beginning. Reversal method. Then you will say the 54,000 we say depreciation is how much per month?
You said 20%.
I mean per year, sorry.
20% per year, diminishing.
So we're gonna say times 100 divided by
80.
So since it's 20% per year, so it means out of 100 we minus 20, we are remaining with 80. Okay.
Hey.
Yeah.
So it means now we'll say 54,000 times 100 divided by 80. So it give you the 67,500. So the 67,500 now will be the carrying amount at the beginning. So CA at the beginning, which will be 103, 2011, it will be 67,500. Then you do your depreciation at 20%. Which it will be 67,500 multiplied by 20%.
13,500.
Okay?
13,500.
So this will be our depreciation for vehicle. Then we have to do the one for equipment. And equipment.
Sir, can I ask,
Yeah, Bo.
how do we see if that depreciation on trial balance and the accumulated depreciation is at the beginning of the year, if it's not like specified?
Okay, you'd now, if they don't specify, you're gonna guide by the date. Like you see, they say accumulated depreciation on. Okay, we've got the equipment at carrying amount. Sharp, that one is no problem. Motor vehicle at cost 120. Accumulated depreciation on motor vehicle is 30,000. The 30,000 that they are giving you here, you see there's no date attached to it.
Yes, sir.
So since there's no date attached to it, which values, normally this accumulated depreciation, you're gonna classify it as what? It's because there is no value attached to it, Moyon. It's gonna be the accumulated depreciation at the beginning.
Okay.
Because normally here, in most cases, they give us at the beginning on this, unless they classify the date, then we're gonna use that date.
Okay.
I can tell that it's long. My ear itchy because I'm wearing the earphones. Sorry. 18 points. Okay, then it means here we're gonna say the equipment given, which is reducing, is depreciating by diminution now. I mean, on a straight line, sorry. So we are given equipment, which they gave us what? I think they give us at carrying amount. Yeah, equipment at carrying amount. And the carry amount was given on the end of the year. Yeah, here they just want you to do a complex calculation. It's because of that pre-max they give you now, this punishment. Carrying amount on, it was on which date? On 29/02. They're given the carrying amount of 120.
It's 24,000, not 120.
24,000, it's not 120.
Oh, it's 24,000. Oh, sorry. So the carry amount given, 120 is cost. Sorry. The carry amount given is 24,000 at the end of the year. Now, the depreciation is written off at 20% per annum. And yes, it's a straight line method. Where's my adjustment? Okay. Adjustment number 7. There's only a straight line method at 20%. So normally we say everything when it comes is new is still 100% complete. So it's 100%. So the 100% divided by 20%, because they say it's depreciated at 20% per annum. So it means this asset will be useful for how many years? 5. So you'll say this divided by this, it will give you 5. So it means only 5 years you can use this asset. Sharp, no problem. Then let's calculate the cost now. Cost of vehicle of equipment. You will say you have a 24,000. So you're gonna use that 24,000. When was this equipment bought? Did they tell us? Okay, yeah.
They say all the equipment was purchased on 1 March 2009.
So from March 2009,
no sale and no.
Yeah, then from March 2009 up to today is how many years? It's 2. It will be March 2009, which it will end in 2010 is year 1, and in 2011 it will be year 2. So up to so far, 2 years gone. Someone camera is on. Okay. So 2 years passed. We all agree. Until the beginning of the year.
Yes, 3 years passed.
So 3 years remaining, right?
Yes.
Okay. So we can happily say 20, in order to arrive at the cost, we can say 24,000 multiplied by
100 divided by 40.
100 divided by 40 or 5 divided by 2, either way. So it's like you times by the total divided by what passed. Are we happy? Because the total is 100. What already passed is 20% at 2 years. So 20 plus 20 will be 40. Or you say the total years of this asset is 5 years, and then 2 already passed times 5 divided by 2. So I think this calculation is just straightforward. It's just a matter of understanding. So we get 60,000 here. So the 60,000 will be regarded as our cost. Then we see 60,000 multiplied by thingy, multiplied by 20%.
Oh, 12,000.
So it's 12,000. So depreciation will be 12,000. So this will be depreciation. So we can conclude that our depreciation is total depreciation it will be the 12,000 for equipment plus the 13,500 on the remaining vehicle. We have to be specified there. On the remaining vehicle, then plus the vehicle sold. So are we happy that the total depreciation will be 29,500?
Yes.
So we can easily take that 29,500 and we plug it here. That's the end of our story. Any question up to so far with regard to this income statement plus the note for profit before tax?
Say, I did see similar question on IPEN question. I saw that when we are required to do a statement of profit or loss, they also do the remuneration notes for directors, but Tina, we didn't do it here. Why not? Oh, it's not
Okay.
important.
It's important. You got by the question. I will tell you why. If a question comes, it says draft the statement of profit and loss for the year ended whatever, and its notes. Then they put full stop. It means you are required to draft the statement of profit and loss. Then after you do your notes will be the profit before tax plus that remuneration thing. Mara here, it was not drafted because the question says note number 1. So let's go to the note number 2. So we should also have note number 2. You see, on the note number 2, it should gonna be that remuneration of the directors because those are the notes comprising our thing, our statement of profit and loss. But if they say as per required, let's go to the required on page 29. So the required part, it was said disclosed profit before tax note. You get it?
Okay.
They didn't say disclose the notes. if they say disclose the notes, then you also have to do it, that remuneration thing.
Okay, so.
But if you can check on your tutorial letter, they did do that remuneration just to show as a guideline. Mara, it was not required in this case. Because the required says solely draft the profit before tax. But if they say disclose the notes relating to the statement of profit and loss, it means you have to do the profit before tax plus the notes for remuneration directors.
Oh, okay.
So we're happy, ne? So that's what guides you how to answer it with a note, remuneration, or answer without that note for remuneration. What do they want?
Okay.
Any other question? No question. So it means we're gonna do a question relating to the statement of changes in equity. Or someone wants PPE. I don't know. I'm not the one. I'm not the one who's gonna write. So you guide me which one you think is harder for you as today. Changes in equity.
Yes, changes in equity.
Okay. I wanna do juice. Hold on. Then I will be with you. You'll also have your small and a break. It's almost 2 hours sitting down. So let's come back. 12:10. Let's do the one in question 7. Yeah, let's do the question 7 one. So let's go to question 7. So question 7, they say we've got information starting page 32 up to 33. We are given the books of Shake It Limited for the year ended in February 2012. Land and building at valuation. Additional information on 1. Ordinary share capital issued at 2 rand. 10% cumulative, 12% non-cumulative. Proceeds of 200 ordinary shares issued. Surplus on revaluation, non-current asset. 15% long-term loan obtained on 1 July. Additional information number 4. Investment. Additional information number 5. Gross profit for the year at mean. Blah blah blah. Income tax, retained earnings, market to market. Additional information. Land and ability associated on F11 Santen with an office block thereon. The property was valued at fair value on the 9th February 2012 for 2.5 million by Mr. J. Peterson. An independent price, no entry was made. Shake It was incorporated on with an authorized share capital of 2,500,000, 10%, 300,000, 12%, 300,000, 14%. 25,000, 12% non-cumulative preference share were issued on 1 September. And then at 4 rand, the transaction already been accounted for. Okay. The finance costs and long-term loans payable annually in areas. Finance costs on the long-term loan must still be provided for. There have been no repayments to date on this loan. Sharp. And then number 5, investment consists of the following. We debit investment, we credit bank 420,000. There was no entry regarding this investment. The share were classified as investment through other comprehensive income. The share are traded on the JSE at 95 rand per share. The following decisions were made by the director in February and must still be provided for. 6.1 capitalization of ordinary shares registered in the share on the February in the ratio of 1 ordinary share. For every 5 ordinary share held, the issue will be funded by means of a profit of 285. The ordinary dividend of 10% per share was declared on 20 February for all ordinary shareholders registered on that date. The company did not pay or declare any dividends on 1 March 2010. There were no further changes. Okay. Then required. File, save as. The question that we were doing before was question, man.
What's question 5?
Okay. Question 5. Touch 102 date 08 and 2022. Paste the 601. And I'm going to close this. Then I will share a new Excel sheet. You tell me when you see it. Can you see the new Excel?
Yes.
Yes.
This will be question 7. We are doing the books of Shake It. Shake It. Statement. And changes in G for the year ended 29 February 2012. The columns ordinary share capital ordinary capital. The children are not making noise, eh?
Sorry?
The children are not
Not
making
really.
noise from my side.
Oh.
Okay, you must notify me if they are distracting so that they can play on the other side. Okay, let's continue. And we've got the 10% cumulative. Then we've got a 12% non-cumulative. And then we've got surplus on revaluation. We've got market to market reserve. Reserve. Then attained earning. Our last but not least, total. Balances in the beginning. Balance beginning of the year. 1/03/2011. Right? How many balances were given as per our information? The share capital was 1.5. We all agree from the pre-adjustment trial balance.
The capital. Yes, 1.5 million.
The 10% cumulative.
Is 300,000.
The 12% none.
550,000.
Okay. Additional information number 3 hearing were issued 1 September 2011. By this, the transaction has already. So when a balance or give a guy or give 550.
150,000, yes.
My answer is no.
No.
Based based on adjustment number 3. Read adjustment number 3 until the end of it.
We will have to. Don't we have to minus there? Because it said it's already.
We have to minus.
And then left with 300,000.
We say 550 minus 25.
You can't minus 25.
No.
You
We
say
will
25.
say
you say
25,000 times 4 rand.
Yes.
And then we minus. Yes. Yes, it's 45.
So it will be 45. Okay, we all happy? Anyone who's dispute? Cool. Surplus on revaluation. How much was the surplus at the beginning of the year?
150,000.
Because the adjustment number also was not yet entered, Akir. Because no entry has been made on adjustment number 1. So we can happily say it was okay, 250, ne?
Yes.
Do we have a balance of market to market?
So
the
he said
balance,
how much? Oh, he says. Oh, okay. I see.
Market reserve, yes, is 40,000 on 1 March 2011.
given, yes.
Yes.
The balance on retained earnings is also given, 800,000.
Yes, both are given.
So we are all happy, right? So now let's work with things that are happening. We've got adjustment number 1, revaluation of land. Here there is no format to do things. You can do things the way you want, as long as you have understanding of what you are doing. Ne? I'm happy. You can start cut total comprehensive income if you have it. Why go to ordinary shares? Why go as long as you make sure that your capitalization will be only after all shares have been issued. So with capitalization, we can regard it as the last thing to do. You are the dividends. So it will be capitalization, then followed by the dividends. So, but any other things you can do the way you want. So let's go as adjustment number 1, revaluation. Unless they tell you that this must be in the following order. Sometimes they do mention. If they do that, they say this must still be taken into account in the following order. Then you just have to follow the way they want. But here they didn't mention, so it means you can do the way you thing. Then revaluation. Revaluation, how much was revalued? Now I was told that the land and building, the property was revalued to a fair value on January February 4, 2.5. So it means that it was worth something, but now it's worth 2.5. So it's 500 more extra. So now my revaluation, I would say, is 500, which it will be the 2500 minus non-cost mute. Thank you. So it's 500. Cool. Adjustment number 2, shakers incorporate authorized shares. These just authorized shares, they've got nothing to do here. Adjustment number 3, the issue of non-cumulative. Issue of preference shares. The preference shares issued, they were how much?
25,000 multiplied by 4.
Which is they are issued none.
Yes. 100,000.
It's hundreds.
None
100,000.
Non-preference share, non-cumulative. Preference share issued 100,000, which is gonna sit here. Adjustment there, Latela, finance cost. Those one they're gonna go to income statement when we are doing the total comprehensive for the year. Adjustment number 4, and then so as adjustment number 5, and two, and then the share were classified as 95 rand. Okay. 120. It's 80 rand. Now they issue 95. That one is gonna be. It's gonna affect our market to market because now the shares have increased in value by how many shares were issued? They issued 1.5. So minus 90 times 220. Right? 2,500. So on the market to market reserve, now we're gonna say, and we have these shares issued, which we can call them the fair value. It's like a fair value adjustment, but here they classified that line item. They just classify it as a total comprehensive income for the year because all those things they affect income statement. You do get it, ne? Because this it affects income statement. This one, you know, at the bottom. So the fair value adjustment, it will be other comprehensive income. The one of the shares held, you remember you asked about the shares held not for trading. So the fair value adjustment on shares held not for trading. So those they go hand in hand with adjustment number 7. I mean adjustment number 5. So on adjustment number 5, we acquired. Let me do it as a calculation here. Fair value So to be safe, let me do it. Let me present in a way that it's gonna be safe for you. This one, let's cut it and bring it down here. And then this one must go top. Then this will be regarded as a total comprehensive income movement. So the movement number 1 is for fair value adjustment on shares held not for trading. So which we're gonna calculate it here. So we say shares acquired is how much in number? Adjustment number 5.
It's 1,500.
In value, how much? In price?
Yeah, they will be 120.
It's 80
It's 80
rand
rand
per share.
Yeah, it's 80 rand. Me, I calculate alone while I was still doing my things here. So it's 80. We all know how to calculate that 8 rand, ne?
No.
No.
Ngwalengwe, hi bo, one disappoint. Obu attend that last day from the beginning until today. Ngwalengwe, this is how we calculate this. I agree we are given 1.5 in number. Ne?
Yes.
Number is given. Yes. 1,500. Value is also given as 120. I get 120. So in order to get the price, this is the formula for price in everywhere you go. You will say value divided by number to give you the price. Ne? So okare 120 divided by 1,005, it will give you that 8 rand. Ne? Verify it on your side.
Yes, I got it.
Okay. So I think from now on, you know how to do this thing. Ne? In any case, if you want the price, you just use the formula. Value divided by a number. So the share we acquired them for 8 rand, ne? On the date we acquired them. But now, on 29 February, the shares are valued at 95 rand. Okay. So the total value of these shares, it will be how much now?
142,500.
So it will be 95 rand multiplied by 1500, which is how much?
142,500.
So the increase in this is how much? The increase by how much?
By 22,500.
We are all fine with this 22,500.
Yes.
So we can happily say 22,500, we plug it here as market to market reserve here. It's an income. We happy? So all these things,
Yes,
they come under this thing is. So if you can say total comprehensive income, and then this one you put them as like underneath with minus, like you say, dash fair value adjustment, dash revaluation, dash profit for the year, you're not gonna get penalized. Then adjustment number 6, they're still gonna happen, ne? So for now, let's leave adjustment number 6. Let's go back to our pre-adjustment trial balance and check what need to go there, but we didn't do it. Land and building valuation is fine. We take it into account, got that 2 million. Ordinary share capital of 150,000, 1.5 is that balance. Cumulative of 300,000 is this one done. 550 of 12%. It came as a result of, it will be 450 plus 100, so it will be the balance at the end of the year of 550. Proceeds of 200,000 ordinary share issued on 31 October. That one we didn't do it. Ne? That adjustment you didn't do it. The proceeds of 200,000, so we have to include it here. Now we can say the issue of shares. They were issued at how much? So let me put it on top now. I will move this again to further down. Issue of shares. Proceed on issue of shares. The shares were issued, acquired how much and in number? We acquired 200,000 ordinary shares issued on 31 for 400,000. So here is in value, we put 400,000. We are happy. So adjustment there, surplus and revaluation at 250 is done, is this one. Long-term loan is not yet done. Investment of the 320 adjustment number 5 is done. The gross profit for the year, yeah, so now we have to calculate the profit for the year because it's not yet calculated. So we're gonna have another calculation here whereby we are calculating profit. So here we have a profit. Profit for the year. So we can say it's calculation number 2. 2 was that one was calculation number 1. So we are given a gross profit of how much?
4 million.
4 million.
And then we can do our things as given. We are given administrative. Do we have other income? Yes. We have other income. Let's just follow
Yes,
the
we do.
formula. The other income given is how much?
100,000.
Okay, let's proceed. Then we have other income. Then we're gonna go to admin. Admin ya rena ke bokae?
800,000.
800. So this will be in the minus. Okay. And then what next?
A distribution with 80.
Distribution cost with 80. And then what next?
Other expenses
Other personal expenses.
with
Other-
120.
Expense.
Other
100
expenses.
120, ne?
20.
Yes.
Then the finance cost. I think that one needs to be calculated as per adjustment number.
Number 4.
Is the adjustment number 4?
Yeah. They say the finance cost of the long-term loan is payable annually in arrears. The finance cost on the long-term loan must still be provided for. There have not been no repayments from the date of the loan until today. The loan acquired is 15% long-term loan, which was acquired in July. So we have July, August, September, October, November, December, January, February, which is 8 months. Ne? We all agree.
Yes, sir.
Yes.
So it's 900,000 multiplied by 8 divided by 12, then multiplied by, it's bearing a percentage of how much? 15%. So it means the thing should be 90,000. $90,000. Then we can have a profit before tax, right? Profit before tax. Then we have income tax expense. Is it given or need to be calculated?
It's given.
So if it's calculated, they will say the income tax expense is at 28%. So it means you're gonna say this times by 28%. Suppose they didn't give you, don't be confused when you be writing exam, it's like you. Why are they saying this? Mr. Mulabi have never say anything about this. So if they say the income tax is calculated 28%, so you're gonna say that 28% of your profit before tax. Suppose, but in most cases they will give it to you. So it's how much?
It's 823,900.
Okay. Then the profit for the year before the comprehensive incomes is how much?
2,186,100.
Yeah, this means 2,186,000.
Hundreds.
Okay. Further things to go in is what?
It's other
Revaluation
comprehensive.
income.
We're gonna have what? Revaluation.
Gain on revaluation of the land.
And the gain of
200.
what's
Revaluation.
surplus to
How much is our revaluation as per year? Our revaluation
200,000 at the
it was
beginning.
500.
is 500, ne? And then another one key, this one.
Mark to market.
The surplus.
Which surplus?
It's not surplus, it's a gain, is it?
Yes, it's the gain. The
Yes.
gain on shares. The shares that were not held for trading. So it can be, you can write as a gain or market to market reserve depending. Gain on financial assets, or you can write it as market to market reserve. Market to market reserve. The total will be that 22,500. This one. So we put 22. Then the total comprehensive income. Total comprehensive income is sum of this plus this plus this. Then is this. So now we can say our profit will be this. We can only focus on this one only. It will be the one taken to here as profit for the year. We say profit for the year will be under retained earnings. Then we'll put that 2186 thing. We said it's how much? 2186
100.
100. Yeah. Then I think from our pre-adjustment trial balance, everything is accounted for. We didn't leave anything there. Next. Then we can proceed, and now we go to this issue of the shares. They said capitalization share happened on which transaction? Transaction 6.1. Capitalization of shares. Shares. Which it will be here. Let's calculate it. Capitalization shares. Can you see my writing? If you can't see, tell me.
No, the color is a bit dark.
I can see the color is too dark. Here. Can you see now?
Yes, it's much better. Thanks.
Okay. So the capitalization of shares, the total number of shares issued. Let's find the total number of shares issued. Total number of shares. On the balance. On the balance, how much was issued on the balance?
115 million.
That was the value. I want the number now. The shares were issued at 2 rand each.
All
Still
right.
remember. So you're gonna say 1.5 million divided by 2 rand.
750,000. 750,000.
750,000.
Yes, 750,000. You put it here. In value, is that 1.5 million. So here's the number. Here's the value. And there were new shares issued during the year. How much new shares issued during the year?
It was 200,000.
So the one issued during the year of 200,000. 200,000 was what? The number, ne?
Yes.
And in value, they were
400,000.
okay. Are there any other ordinary shares issued? I didn't see them. So we can say the shares now, they equal so capitalization is what share for what share? The capitalization of how many shares? of one share for every 5.
For every 5
The
ordinary shares.
Sorry? We get, you were saying something?
No, it's someone else. I just gave the number of the 5 shares. I think someone else was trying to speak.
Yeah, can that someone come back because we didn't hear what she wanted to say. It's just I didn't get the person.
Soft shares at the
Sorry?
700.
700,000.
Balance on the balance at 750, not 75.
Non-Tanta, you say balance is what?
It's 750,000.
750,000.
When I 75,000.
Okay, the 750,000. Where do you get the 750,000?
She said when you write 7.
Oh,
The number of shares at the beginning is not 750,000.
Okay. Sharp. Thank you.
The number shares is 1.5 by 2.
Then the capitalization.
When you wrote 75,000.
Yeah, I fixed it. Okay, so now we're gonna say 950 divided by
5
times by
1. It gives us 190,000.
so we have 190 here. So they were issued at what value? They said they're gonna use the 285. So here they say they're gonna use 285. They are telling us sharp. So now we can say equal this plus this. Here equal this plus this. Sharp. Then on our statement of change in equity, here on this column, we're gonna say capitalization of shares. You see, I put that 285. You remember this 285. So we're gonna say on the issue of shares capitalization, then we put 285 here under. Okay, let me do this. View this page. Yeah. Then yeah, sharp. Here now we're gonna say that 285, we're gonna put it here under capitalization. We put 285 here. We are happy. Anyone who have an issue? So it's gonna be deducted from the retained earnings.
Mr. Malako, can I ask a question, please? If we were not given the funded amount, I believe we're gonna take the total ordinary shares, we divide it by 5, and then we times it by which amount now? In case we were not given the funded amount.
Yeah, it's fine. I get you. Suppose we're not given the funded amount. Here, we're gonna say, now you're gonna say 190 divided by 950,000 is how much? You'll say 950. I'm sorry. 1,900,000 divided by 950. You are gonna give you 2 rand, ne?
Yes.
Then we're gonna say that 190A wait times like a 2 rand. Or unless they say the capitalization of shares held, blah blah blah, for one ordinary share for every 5 at 1 rand. So it means you're gonna say 190 times 1 rand. Or if they say at 2 rand, then you say 190 times 2 rand. If they didn't give you that fund value.
Okay.
Yeah. Happy? Then we can go further. Then what left, it will be the dividends. Then we declare the dividends. Dividend declared. So the dividend to be declared, we're gonna have preference shares. Start with them. And then we have ordinary. So let's calculate the dividends. Calculation of dividends. Calculation of dividends. The dividends, let's start with cumulative preference shares. The preference shares, cumulative. They will say the shares, they were issued, blah, 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 and then they were not declared. Meaning. You mentioned something there. Adjustment number.
Adjustment number 6.2.
Adjustment number 6.2. They said ordinary dividend of 10 cents per share was declared in February for all ordinary shareholders on that date, and the company did not pay any dividends on 1 March. So since 1 March 2010, they didn't pay. So financial years ending on, because the financial year ended 29 Feb.
February 2012.
Eh?
29 February 2012.
For the financial year ended 29 February 2011, no payment.
Oh.
The financial year ended 29. We are doing the one for 2012, ne?
Yes, now we're doing for 2012.
Okay. Then we are doing the 29 February. It's where there is sharp. Then we will say only 1 year was not paid. You can see, ne?
Yes.
Then we will continue. God, okay. The shares which they were issued at the beginning of the year for preference, it was 300,000. Oh, they didn't issue any other additional. There were no additionals. So we will say 10% cumulative of 300,000. So how many shares were issued, we don't even know. But it's fine as long as we have the price, so we can use that price. Or they were issued 300,000 in full. Okay. So we'll say 300,000, 10%, multiplied by 10%. Then multiply by 2 years, because it will be year 1 and year 2. This will be year number 1, and then this will be year number 2. It makes sense, Akio?
Yes.
So we say times 2 years. How much dividend need to be paid in respect of the preference shares?
60,000.
How much?
60.
60,000.
60,000. Okay. Then for non-cumulative,
Non-cumulative, it's 450 times 12.
boom, 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 boom. I refuse. You have to differentiate 450 times 12, then times 1 year only, right? And then also do the one for the 6 months. So we'll have the balance, from the beginning on the balance. It will be the 450 multiplied by 12%, ne? Times 1 year. Because they were balanced at the beginning for the whole year until the end. 1 year. So value I wanna give a guy.
54,000.
Oh. And then the other balance which was issued during the year. There were certain shares issued during the year.
It was 100,000. 100.
Yes, it was 100,000.
Yes.
So you say 100,000 issued during the year.
It was issued on September. No.
September.
Yes. It was September 1.
Which it will be 100,000. Multiply by
6 months times 12%.
which is
6,000.
So we are all happy, ne? So
Yes.
preference. So this it will be for non-cumulative. So in total, they will go as the one for cumulative, it will be 16. Eh?
Yes.
And then the other one is also gonna be 60. So in total, will be 120 here. We all happy, ne? Because it's both cumulative and non-cumulative as done here. And then lastly, you're gonna do the ordinary shares. Ordinary shares. On the ordinary shares, we have a total number of shares issued. After capitalization is how much? To be this. To remember this value, ne?
Yes.
So we're gonna say the 114. Total shares issued is 114. 114.
It's 1,140,000.
Okay. So we're gonna say that 1,140,000 multiplied by. You say they're declaring at
10
what
cent. 10 cent.
10 cent, which is 0.10. And 114,000.
Okay.
So we can take that 114,000 and we plug it here. So that will be the end of the story. Then we can add whatever we need to add. Yeah. Then this one will be 100, 400, 2,500, 500. Here it will be like it's 0 because this will be 285. That's it. Any question?